Join Samantha and Hans at the next Macro to Micro Options Power Hour, held each Wednesday at 4 p.m. Eastern Time. Registration is free. Scan this QR code or click on the link in the description.
We need to talk about April 2nd tariff deadline and the end of month, which is fast approaching on that 31st Monday. The April 2nd warning by Goldman, speaking of downside demand, there isn't any. How would you position into potential volatility next week? And just if I can get this quote real quick, Goldman Sachs economists note recent media reports have suggested the Trump administration is leaning in a more benign direction on tariffs. Don't be fooled, they write. That attitude probably sets markets up for a negative surprise. And I don't know what Nomura said. You get those, I don't. Goldman notes the Trump admin has seen tariffs as a negotiating tool and will likely want to start from a position of strength. A recent Goldman survey shows that market participants believe reciprocal tariffs coming in April will amount to a 9% reciprocal tariff rate. Goldman itself expects that the initial tariff rate could be double that, which would set the market up for a negative surprise next week.
Does it feel too early, Samantha, for Trump to kind of throw in the towel here? I know it's the art of the deal.
I don't expect him to throw in the towel at all.
No.
Zero. For me, this is not going to happen. He's going to try and negotiate, of course, that they remove their tariffs. So there's no way he's going to give in on anything unless he gets more than what he's asking.
Right. I'll show you mine if you show me yours is going to be Trump's play
and
here.
You first.
Yeah, and look, I think you first, right? So I think I think this volatility. I think where the VIX is now is a bit of a gift, and I think when the VVEX gets under sort of 90, 95, that's when the volatility of volatility, so the cost of owning volatility, gets low. And so I think it's a bit of a gift here. Like whether maybe you don't want to play upside VIX because it's maybe not as reactive, but it's cheap, or you could just buy some. You could just simply buy a downside put spread. This doesn't have to be complicated.
I like that idea. This is what I really think is just easier than dealing with VIX. I know you love VIX, and I can technically analyze VIX, but cows come home. But ultimately, it is just so much easier to throw a directional put with time or a put spread when we have this kind of mercurial market backdrop. So
exactly, give yourself a little bit of what we call Vega, right? So you don't want to buy. I can't remember who I was telling, but there was this Goldman study showing all these different protective structures, collars and put spread collars and straight up puts and put spreads and different things. And the absolute worst product was just buying short-term downside puts. Now, you could be right. If you call a giant sell-off tomorrow and you just bought some puts, of course you're going to be right. You're going to own a lot of gamma and you're going to get huge reaction out of that. But the fact is, there's a put spread fund index put out by CBOE in 2022 when the market was down 18%. How do you think that put spread fund did? It bought puts every single month. It lost money. It did worse than the S&P. So a put spread fund that owned downside puts in 2022 lost money. So that is about all the lesson you need really to understand how to sort of position yourself in protection. You want to wait till things get cheap, which they are right now. And if you're long equities, fine. If you're wrong, you're happy to see your house insurance go to zero every year, aren't you? It means your house didn't burn down. Great. So now it's cheap. You can put yourself in some downside puts. It's not too expensive. You want to give yourself, generally, I kind of like sort of 7, 8, 10 months, maybe even up to a year, depending on where how pricing looks to me. And you're going to give yourself Vega exposure, which means if volatility explodes, you're going to get that benefit of implied vol going up, as well as the benefit of your delta, which means you're going to make money as the market comes down. So that's how I'd be looking at things. I would sort of look at maybe 10% out of the money puts at about the 10-month mark in terms of the expiry date, and strap some on. Look at your position. Don't spend 20% of your portfolio value, but give yourself a reasonable amount. I'm not sure where it's pricing right now. It's probably around 3.5%, but I'd have to take a look. And that's how you do it, really. And you're going to get what you get. The thing with VIX is it's very sentiment based. The VIX is it's mean reverting, right? As you mentioned earlier, it's going to go up, but then if you don't monetize it, watch out, it's going to come down. But if the market goes from 5,500 to 4,500 and you've got the 5,200 puts, you can be sure as heck that those things are going to be worth a ton of money, right? They are worth what they're worth because they have a strike associated with them, whereas the VIX has no strike. VIX 25 is meaningless versus the S&P. Mm-hmm. Yes, they're correlated, but in the end, it is kind of meaningless because we could go to 4,500 and everybody calms down and the VIX goes right back to 20 and you're not up money on your protection. So there's something to be said for being...
It's another style of trading. There are
Yeah.
traders that only trade VIX, but they have very, very advanced option tactics of many, many, many different strikes and buying and selling and basically drilling down that margin. And then they
Yeah.
are there for whatever happens, and they will monetize no matter what because they are experts in trading VIX. I just, in my little travels of looking at all markets, all sectors, all stocks, it is much easier to trade directionally when I have an edge and then not trade when I don't have an edge. And right now, I think this is a mercurial market. The folks are really trying to figure out, are we going to have a V-shaped recovery? Tom Lee is out always saying we are. But the reality is I don't think we have the market structure to get V-shape unless we have the macro trigger full stop. And I do not see, unless Trump can really, really make China do what it wants, make all these other countries drop all of their reciprocal tariffs, that we're going to have a backdrop without tariffs. I don't think we're going to have a backdrop without spending, but we are going to have a backdrop of more job loss from the government shrinking. We are going to have a detox period with equities, whether you like it or not, because money is going home to chase yields that are rising abroad from stimulus and or more safety from what we have right now with our mercurial markets. So pace yourself in a different stage, but for right now, we're going to be starting earnings in a few weeks, and we'll get to see a little bit more. I mean, we have to get through Netflix, but my point is that's going to be the big tell also for sentiment. If Netflix is as good as it gets, like you said, then we're going to have some more kicking and screaming by equity holders, equity investors who are like, what happened to my concentration that was so easy for the last few years? It's going to get harder.
Yeah.
They're going to have to go into other things that are kind of like, I don't understand industrials.
Right. That's right.
I don't understand any of these other things. I know what Netflix does. It's going to be much more work, and I don't know if they're going to want to do it, but we'll get there.
Join Samantha and Hans at the next Macro to Micro Options Power Hour, held each Wednesday at 4 p.m. Eastern Time. Registration is free. Scan this QR code or click on the link in the description. Watch the full Options Macro to Micro Power Hour episode by clicking on the video here, and subscribe to LaDucTrading YouTube channel for more content.